Asia-Pacific markets are all falling in the region as the US Federal Reserve held its benchmark policy rate, but signaled at the same time that it will hold higher rates for longer and raise interest rates one more time this year. Along with the rate projections, the Fed also sharply revised up its economic growth expectations for the year, with the gross domestic product now expected to rise 2.1% this year. European markets are also heading for a lower open ahead of a raft of interest rates decisions today, from England to Turkey, passing by Sweden, Switzerland and Norway. And now let's go to our guest, Jamil Ahmed. Let's talk a little bit more about that. He's chief analyst at online trading brokerage GTC. Thank you very much for joining us today. Right, Jamil, economists on the whole really find the higher for longer stance plausible, and speaking about the Fed, but they are less convinced by Powell's warning that the Fed could implement another quarter-point rate rise this year. Do you agree? And if yes, why?
No, I don't agree. Actually, if you look at the US economic data and the forecast, you see that growth has been revised higher to just above 2% GDP growth for 2023. If you look at other advanced economies, you can add them together and they're still not going to get to 2% annually. At the same point, what's more frustrating actually is that the market was relying on a signal coming in the second half of 2023 that the Fed might actually cut interest rates later into 2024. And I think we've just dashed those expectations drastically. And this also suggests that we're going to have a stronger US dollar to stay. So we don't always just have the stronger inflation, higher inflation for longer to continue forward. We also have that the US dollar is going to remain significantly stronger into 2024 because, quite frankly, the US economy is able to handle the higher interest rate policy, which is the envy of other central banks. Because if you look at Europe, you look at the United Kingdom, the data spells out very clearly that these economies cannot handle high interest rate policy, but they're having to handle it because of inflation. Whereas the Fed have got things far more better under control. And I would say that's more of a worry that economists need to be concerned about rather than second guessing the Fed, who have done their job very well.
Very, very interesting what you say, especially those growth forecasts in the US. They were very positive, but a very different picture in the UK, though. What do you expect then from the Bank of England?
Exactly that. It's the tale of two different tapes here completely, because you have the United States, which is raising interest rates because the economy is doing well, given all global uncertainties. But the Bank of England are backed into a corner because of the persistent inflation headwinds. Although inflation did drop down somewhat last month, it's still more than 3%, the Bank of England target. And if you look at the shock higher in US oil price, where we're getting closer towards $100, then I do think that the Bank of England will continue that forecast that we're going to need to raise interest rates even higher. Because if you look at inflation expectations, it should average somewhere about 7% into 2024, which is higher than where it currently is. This spells out that the Bank of England will need to raise interest rates, even if there's some doubt that they're going to do so in their meeting conclusion in just a couple of hours. I think that they will signal the same message as the Federal Reserve, as the ECB, the European Central Bank, that inflation is here to stay higher for longer. As such, the Bank of England will also need to act, and this is why the British pound against the US dollar has fallen to its lowest levels in more than 3 months. And in fact, it looks like we're going to have further lows as well.
Very, very interesting analysis, Jamil Ahmed. Thank you. And now let's go to other top stories from around the world. Brazil's central bank has lashed its benchmark interest rate by another 50 basis points to 12.75%. The bank has also signaled it will keep the same pace of monetary easing at least through the end of the year. President Lula da Silva has repeatedly criticized the central bank for high borrowing costs amid cooling inflation. New Zealand has revised its growth figures, revealing that a technical recession earlier this year never happened. The country avoided a recession in the first quarter of 2023, with quarterly economic output being flat in the January-March period, rather than shrinking 0.1% as previously estimated. Meanwhile, the economy in the 3 months to June 30th showed quarter-to-quarter growth up to 0.9%. And Toshiba is set to end its 74-year stock market history after a group of investors acquired a majority stake. The 148-year-old Japanese industrial conglomerate said that a $14 billion tender offer from private equity firm Japan Industrial Partners had ended in success. The stock is expected to be delisted from the Tokyo Stock Exchange by the end of this year.